Hey guys, what's going on? My name's Adam and welcome back. So today we're going to be doing 5 stocks that I'm personally buying in October. And so if you do like this video right off the bat, please consider giving a like and subscribe. And we're going to get right into it, okay? So first company is Nordstrom, and of course it's a retail chain company. And it has been absolutely beaten down, demolished by over 70% since the start of the year. Of course, mostly due to the pandemic, as its store sales had to close down. And this is a stock that I think is being missed out on Wall Street investors. And I think this is a stock that they probably lump in with something like a Macy's, a Sears, J.C. Penney. But what I don't think that they understand is that Nordstrom has been able to successfully get into the online space when it comes to selling their products, and that it caters towards, at least the Nordstrom department company caters towards higher end buyers, so sort of upper class buyers, since the products are a bit more expensive. But what I do like is that they also have their supplemental store, which is Nordstrom Rack, which again has cheaper products that are more affordable, right? So I think because of those two business models, plus because um, they were able to move online faster, that they will not have to file for Chapter 10 bankruptcy, like for example Sears did, right? I think totally completely different business model, something than like a Sears or a J.C. Penney, right? So as we can see here, tiny company right now at only $1.8 billion. And of course, they've been losing money, as we can see here. If we go on the quarterly results here, so second quarter they lost $521 million against a revenue of $2.1 billion, which used to be like $4.5 billion in first quarter of 2020. However, what I like to see is that now that they've normalized operations and are operating online more and are slowly reopening stores, they're losing less money, only 255 million instead of 521 million, right, quarter over quarter. Also, what I like to see is that even with certain hedge fund positions, they have been sort of relatively stable over the quarters, and have actually increased the number of hedge funds who have been invested in Nordstrom from first quarter of 2020 to second quarter of 2020 by I think like two. And it talks about right here that the largest stake in Nordstrom was held by Arrow Street, which held 47.7 million worth of the stock, and then next one came in at 32.8 million, right? So one thing that I really find interesting is that so pretty much 34% of the shares are pretty much has been shorted, which is just an insane amount. I've actually never seen that high a number on any stock, at least this year, or at least anyone that I've been invested in, and I do own Nordstrom stock. And so what I think may happen, especially if the next quarter results come in and they're positive, that there might be something termed the short squeeze, which could pretty much shoot this stock up by a tremendous amount, right? Because having more than a third of the stock shorted is absolutely ridiculous, and this could literally send the stock up by like triple the amount, right? So, because I do think that a lot of people are considering that this stock will pretty much be filing for bankruptcy soon, but I'm not so sure, right? So let's look towards especially earnings season, and especially going to the main spending season for retailers is coming up into Christmas, right? So yeah, that's why I believe in Nordstrom and might add a little bit to my position in Nordstrom, right? Next one is Zoom. Okay, no, I'm joking. I'm not buying Zoom right now. If you look at this P/E ratio of 600 and right now market cap of 133.7 billion, I think it's just like way too overvalued. But the next stock, why I mentioned Zoom is because it's sort of in a related space, but it is not overvalued in my opinion, and that is Slack. And if we look at the max chart for Slack, we can see that it IPO'd in June of 2019 and is sort of down by like 27% since then. Company that's right now at $15 billion, and it is so close to getting to not losing any money anymore, right? So that's definitely something that I like to see, and I do own Slack, right? So if we can see right here, if we look at the quarterly results, against a revenue of 215 million, they lost 74.8 million dollars, right? However, when we look at the expected growth for next quarter, so January 2021, 29.2% revenue growth For the whole current year, 39.2% revenue growth, and for next year, 28.5% revenue growth, which is just absolutely ridiculous in my opinion, right? And so they're saying here, after adjusting um, for stock-based compensation and other factors, the software company reported pretty much a break-even quarter, right? So after adjustments, they reported break-even. And one thing that is really, really insane to me is that paid customer growth, which is the single most important driver of the business over the long term, accelerated in Q2, up 30% year over year, which is insane, says chief executive, right? And because they have sort of like a free trial that businesses can try out, not when a business goes on the Slack platform, it takes a while before those companies actually pay Slack, and then that transfers to their revenue growth, right? And here there's just a video from Kamath, I hope I'm pronouncing that right, who worked in the bowels of pretty much Facebook and knows a lot about the sort of online tech business model, and he sees that Slack and Zoom are the only ones in the space that he's comfortable investing in. But as I said before, I believe that Slack is less overvalued.
You brought up Slack, so let's go there. You own 10% of the company. You're on the board. I know you're limited about what you can say as a result of all of that, but when can we expect it, and why the direct listing, and do you agree with that decision?
I love it. I mean, I think that the decision-making that Stuart has taken is incredible, both in the way that he's built the company, he's transforming the culture. He understands the product to a level of sophistication that I've not seen since Facebook. You know, when I was in the bowels of Facebook building that machinery, what I saw was a team that really understood product market fit and power of network effects, and why that created an incredibly subsidized business, a thing that could expand all over the world at marginally zero cost. The only company in the world that looks like that today, that is not yet public, is called Slack, and it will be soon. And so from that perspective, I think it is the most incredible business that we have seen. Probably the next closest thing to it is a company that just went public recently, which is Zoom.
So
Right. So, and again, you can search his credentials more, but whenever he says something like that, I definitely my ears perk up. And so I do think that right now, Slack is not necessarily a bargain, but I do think that based on the revenue growth of like 30% next year, it is definitely a good play, and especially as more companies transition online. And I mean, like when you think about it, the office space is never going to be the same again, right? Like we're not going to reach 100% people coming back to the office from a 9 to 5 job, I believe, ever again. Like a lot of companies, even like Facebook, for example, are letting their employees work from home even if the pandemic rolls over, right? So I do think that this is really good news. And even if we look at the numbers, we can see that the paid customers increased quarter over quarter by 12,000, right? Which is a huge number. And although net ads went from 12 to 8,000, which is a decrease in 4,000, this is most likely because companies are struggling throughout the pandemic, so they have less money to spend on ads, right? But hopefully this will resume as the world opens up again, right? So also, one more thing I want to point out is that I would say the main competitor to Slack is Microsoft Teams, although that Slack was in the space earlier than Teams. Teams pretty much surpassed them just because it's run by Microsoft, which is like a $1.5 trillion company against like a $15 billion company. However, when you look at the large organizations that Teams versus Slack cater to, it looks like, of course, Teams is a huge winner. So large organizations that use Teams way surpass Slack. However, when we look at the reverse side, so we look at tech startups and smaller companies, they use Slack more than they use Microsoft Teams, right? And they plan on, I believe, seeing this trend continue, and so hopefully Microsoft Teams will stay in the background. So I do own Slack, and I do believe that they will eventually be able to play with the big boys and have high-paying customers like Microsoft Teams, but maybe just not, in the immediate future, especially as Slack develops more of their technology. Okay, next stock is again one that I own, and in the past month it has definitely been beaten down by over 14%. And this is a very, very small company, as we can see here, $321 million market cap. And I bought around like $4.20, so I will be looking to add to my position as it continues to go lower, if it does go lower, right? And the reason why I like this company is because it's vertically integrated in the MJ space. So it currently holds 6 licenses in the Nevada market, and it operates one sort of major entertainment center in Las Vegas, and it is the largest cannabis entertainment complex on the planet. Okay, located in Nevada, so the entertainment capital of the world, and is planning on opening another store in California, right? So I think that this is the transition in the MJ space, especially as it goes, it becomes legal. Hopefully, maybe even with like a Biden presidency, we should be seeing some positive changes on that front. But even though I think this is like the leading company in this space, right? And as we can look at their annual reports, we can see in 2019 they pretty much tripled the revenue, which is of course something that I like to see. And if we look at the next year, their projected revenue growth is 116%, which is just absolutely insane. So if they reach those numbers, definitely I expect to see the stock going way, way, way up. Okay. So the next one is also involved in the tech space, similar to Slack, except this one connects pretty much companies that are looking for employees. And so it's changing the way businesses find, hire, and pay highly skilled freelancers for short-term and longer-term projects. And so, of course, as independent workforce goes online, knowledge work, similar to software, shopping, and content before it, is shifting online as well. Upwork has built an expansive and unique repository of data on its platform, which, when combined with machine learning capabilities, enables Upwork to best predict the availability, interest, and skill relevance of specific freelancers for specific projects, right? So that is a really fantastic business model, especially into the future, as I think everything is going more and more online. And if we look at the Q2 balance sheet, we can see that, of course, the revenue that they earned from previous year in the same quarter was up. I believe this is like 19% increase from 65 million to 78 million. However, they lost more than in last year. They went from like 2.8 to 11 million, so increased their losses. And why is that? It's because pretty much they spent more money on research and development and on sales and marketing. As you can see, they even spent like about 10 million more in sales and marketing from 3 months ended June 30 in 2019 versus this year, right? So that's why they're losing more money. But it is really, really good to see that the revenue is increasing and will continue to increase, right? And as we can see right now, if we look at the max chart, it has been pretty much beaten down since the IPO, and it's down like 16%, and only like a $2.1 billion company that's valued at right now. However, when you look at into the future and when you look at current revenue growth, which is expected to be 17% for the current year, 14% for next year, so pretty much double-digit growth into the future, it should be a revenue beast and potentially an earnings beast for some time to come, right? And so I'm not in this position yet, and I think definitely if it comes down to like around the $15 range, I think this stock is a very, very attractive buy, right? And the last stock is more of a value play, and it is Walgreens. Okay, I bought this stock when it was around $38. Now it's like $36, so definitely a bargain. Up from highs of like $59, so down like 39% right now with a dividend yield of 5%, which is just ridiculous, right? It's valued at $31 billion. If you don't know, it's sort of like a pharmacy slash convenience chain. And although it seems like 44 PE ratio is quite high, when we look to the forward PE, which is, in my personal opinion, a better measure of PE, is 7, which is insanely low, especially in this market where the PE ratios are on average around like 25, I would say, right? And of course, right now when we look at earnings, so annual earnings let's look at quarterly. Of course, they lost money in second quarter of 2020. And did a little bit less in revenue, but even not so much, especially as people can't go to the stores. So this is surprising that they're actually able to keep revenue relatively stable. And of course, as they're transitioning online, online store sales and etc., they are obviously going to lose a bit of money. So they lost $1.7 billion. But they are expected to grow, of course, 2.8% next year, 1.7% this year. So as things more normalize, I do believe Walgreens is definitely a stock to be in, and I do own shares in it, and I will be looking to add to my position, especially if the stock drops lower, right? And they're most likely not going to be decreasing their dividend anytime soon, right? Not a company that's so established, right? That would look pretty bad. So, pretty much pharmacy chains are facing increased competition from online giant Amazon. They must adapt to thrive, and that's exactly what Walgreens is doing. So pretty much on a step-by-step basis, what they're doing is that put in motion a plan that'll provide $2 billion in annual savings by 2020 to improve front-end sales and increase repeat pharmacy customers. And right now, it's sort of hard to, of course, get pills, for example, through online shopping and Amazon. So this is why I think that the pharmacy chains are definitely a good idea to invest in, because that's something that is not online yet, right? And so I would say one of the most exciting aspects of this transformation is Walgreens' partnership with Village MD. So they're working together to create an integrated primary care and pharmacy model co-located at Walgreens locations that'll be perfect to treat patients with chronic illnesses. And so up to 700 of these full-service doctor offices should be up and running within 5 years, right? So this is something that is really, really hard to put online. And although online, shopping is being replaced for everything with retail to food, I think with pharmacy it's going to take a lot longer. And so, but they're also, trying to digitize themselves to drive growth, right? So, we've seen spikes in their like digital ordering and a broader selection for drive-through pickup options, and so we should see a healthy uptick of that organic growth sector, right? So I do think that with a yield of 5.2%, it is definitely an attractive value play, and I do plan on holding this Walgreens position for quite a while. So again, if you did enjoy this video, please be sure to give it a like and subscribe, and thank you for watching this far. And I hope you guys have a fantastic day. See you later.